Right, welcome to our last lesson in this chapter, which is on estimating our inventory. We're going to talk about estimating the cost of merchandise inventory, as well as talking about two financial ratios, the inventory turnover ratio and the days sales in inventory. Okay, so first up is our gross profit method of estimating inventory. We have done this one before when we talked about estimating inventory in accounting at the end of the Accounting 1 book earlier this year. When a business needs to determine the cost of merchandise inventory so that they can prepare their monthly financial statements. Now, most merchandising companies maintain a perpetual inventory using our stock records or a computerized accounting system like we just did in our last lesson. They'll do LIFO or FIFO or weighted average. But sometimes when you're a smaller merchandiser, the cost of maintaining a perpetual inventory system might exceed the benefit of using one. And having to do a physical inventory every month can also get very costly. So a cost-effective way to estimate our monthly ending inventories was created by some small businesses. And that method is called the gross profit method of estimating inventory. It's where we use the previous year's percentage of gross profit on operations to estimate our ending inventory. Now, this method assumes that there is a continuing relationship that exists between our gross profit and our net sales. Now, based on experience in previous fiscal periods, a gross profit to net sales percentage is then calculated, and then you continue to use that percentage as you go. So here's an example of a gross profit method. We start with our beginning inventory, which would be given to you. We add in our net purchases to date, and that gives us our merchandise available for sale. Then we take our net sales to date, and we take out our estimated gross profit. And then what we do is we take net sales times our estimated gross profit percentage, which they will give you at 48%. And then that will give us our estimated cost of merchandise sold, which when we subtract those two, we'll end up with our estimated ending inventory. So a much easier and much more cost-effective way. The thing is that it is an estimate. It is not accurate like a LIFO or a FIFO or a weighted average. This is truly an estimation, so it's not recommended unless you are in a situation where the benefit of doing what we just talked about, LIFO, FIFO, weighted average, doesn't outweigh the cost of doing it for you if you don't sell that much inventory. Now, a new method we haven't talked about yet is our retail method of estimating inventory. So this is where we estimate our inventory by using a percentage that's based on two things, the cost and the retail prices of our ending inventory. Now, the retail method can be used instead of the gross profit method. The thing to keep in mind with this retail method is that as a business, you actually have to keep separate records for both cost and retail pricing of things like your net purchases, your net sales, and your beginning merchandise inventory. So you are essentially creating more work for yourself because you need to keep separate records for all of those things. So here's an example of our estimated merchandising inventory using our retail method. So here you can see we have cost and retail. So we have our beginning inventory before our net purchases to date, and when we add those two together, that gives us our merchandise available for sale. Then we have our net sales to date, which is the only one that is specifically for retail. And then we have our estimated ending retail after we take our merchandise available minus sales, we get our ending inventory. And then we take our ending inventory at retail and we take that times a percentage, and that gives us our estimated ending inventory cost. Now, most businesses that need to estimate typically use the gross profit method because it doesn't require us to keep separate records for everything. However, You do have the option to do the retail method. It is still GAAP approved. So we are going to practice that one as we go in this chapter so that you are aware of it. Now, another thing that managers often like to look at is a few financial ratios related to merchandise inventory. So obviously, the more rapidly a business sells merchandise, the more chance it has to make a better net income. Now, there are two measures for the speed of merchandise inventory. One is an inventory turnover ratio, and the other one is a day's sales in inventory. So we're going to look at both of them. Our inventory turnover ratio is the number of times the average amount of merchandise inventory is sold during a specific period of time. What this ratio expresses is the relationship between our average inventory on hand and the cost of merchandise sold. So merchandise inventory, obviously, we know represents a large investment for most merchandising businesses. We spend a lot of money on merchandise. So a low inventory turnover ratio means that we are having a low return on our investment, which is not good. We always want high returns on our investments. So how to figure out your inventory turnover ratio is you need to take your beginning inventory and your ending inventory, and you add those two together and divide by 2. That's obviously going to give you your average merchandise inventory. Then we take our cost of merchandise sold and divide by our average merchandise inventory, and that's going to give us our inventory turnover ratio. Your ratio will look something like this. It could be 5.84, it could be 6.32, whatever it happens to be. That ratio means that the business sold the average merchandise, remember this right up here that we found, 5.84 times during the current year. So whatever your average merchandise on hand is, you take that divided by your cost of merchandise sold, and that will tell you how many times you sold that average merchandise during the current year. Now, another ratio we like to look at is our days sales in inventory. This essentially tells us the time that's needed to sell an average amount of merchandise inventory. The thing we have to remember is that in order to calculate our days sales in inventory, we have to have calculated the inventory turnover ratio first because we need that inventory turnover ratio to calculate it. We are always going to round the number of days sales in inventory to the nearest day. We don't really do half days. That accuracy is still acceptable by GAAP. That rounding is okay. So here is the day sales in inventory. You take the days in a year, which is 365, and we divide that by our inventory turnover ratio. So if we had 365 and our one before that is 500 or 5.84, that was our inventory turnover ratio, our days sales in inventory would be 63. So what that means is that on average, each item in inventory is sold 63 days after it's purchased. So you buy something as merchandise and you don't actually make that sale for 63 days. So what that means is that the higher the number of days in inventory, the longer merchandise tends to remain unsold. When you have unsold merchandise, that means you are not making a profit off of it. So in order to try to reduce our financial ratios, we can try to reduce the size of inventory that we keep on hand. However, that's a very dangerous thing to try to do because lower inventory levels could mean that you aren't able to meet your customer demand. So a customer comes into your store and you're keeping low inventory levels. They don't, or you don't have the product that they want, they're going to leave and look for it in another store, and you may have potentially just lost a customer. And another way to think about improving your financial ratios is by increasing the amount of merchandise sold. Both of these ratios are dependent on cost of merchandise sold. So obviously, if you sell more, that's going to increase both of your ratios. So we can head on over. We'll do our 5-3 work together, and then you'll have a couple of assignments to complete on your own.